Have you ever wondered how you can get a real sense of a company's financial health, like in a single glance? Or even just get a clear picture of your own finances? Well, there's a super powerful tool for that, and today we're going to break it all down. All right, so here's the game plan. We're going to start with the basics. What exactly is a financial snapshot? Then we'll get into the fundamental equation. This is the unbreakable rule behind it all. From there, we'll look at the two big sides, what a business owns and what it owes. We'll even make it all balance with a real world example. And then we'll wrap up by talking about why any of this really matters. Okay, first things first. Let's get right to the heart of it. I want you to forget about all the complicated spreadsheets and confusing jargon for a second. Because really, a balance sheet is just a simple, powerful picture. And to make this real, let me ask you a question. If I asked you right now to give me a single picture of your financial health, what would that look like? What would you even put in it? It would probably boil down to something like this, wouldn't it? On one side, you've got all the stuff you own. Your cash, maybe a car, your house. And on the other side, you'd have everything you owe, things like a car loan or a mortgage. And that simple idea, that's the bedrock of every single balance sheet out there. And that brings us right to the official definition. A balance sheet is basically a summary of all your financial balances, but, and this is key, at a single point in time. That's why we keep calling it a snapshot. It's not a movie showing you what happened over a whole year. It's a still photograph of exactly where things stand on one specific day. All right, now let's talk about the engine that makes this whole thing work. There's this one simple, unbreakable rule. It's like the law of gravity for accounting. And here it is. Assets equals liabilities plus equity. That's it. Every single balance sheet on the planet, I don't care if it's for a tiny corner store or a massive global company, is built on this one elegant equation. All it's really saying is that everything a company owns had to be paid for somehow, right? It was either paid for by borrowing money or by using the owner's own cash. So let's break that down. First up, assets. What are they? It's simple, really. Assets are just all the valuable stuff a business owns. We're talking about anything from the cash in the bank, to the computers on the desks, to the giant factories they operate. Okay, so liabilities are pretty much the exact opposite. They're what a business owes to other people. Just think of it as the company's debts, money they have to pay back to suppliers, loans from a bank, you name it. It's basically the claim that outsiders have on all those assets we just talked about. And that brings us to the last piece of the puzzle, equity. This is the good part. After you take all the company's assets and you subtract everything it owes, the liabilities, whatever is left over, that belongs to the owners. That's their piece of the pie, their stake in the business. It's what we call the company's net worth. All right, so we've got the big equation down. Now let's zoom in and take a closer look at that first part, the assets. So assets usually get broken down into two main categories. You've got your current assets. These are things the company expects to turn into cash pretty quickly, usually within a year. Think about stuff like their inventory or something called accounts receivable, which is just a fancy way of saying the money your customers still owe you. Then you have the non-current assets. These are the big, long-term things, like buildings, heavy equipment, or even valuable patents. Okay, let's flip over to the other side of that equation. Like we said, everything the company owns had to be financed somehow. So let's see where that money comes from. Right, so this side is funded by one of two things. First, you have liabilities. That's the debt. Stuff like accounts payable, which is money owed to suppliers, or notes payable, which are just loans. And the other source of funding? That's equity. This is the owner's cash. It could be their initial investment, what we call capital stock, or it could be retained earnings. That's just the profits the company has kept and put right back into the business to help it grow. Okay, all this theory is one thing, but seeing it in action is another. Let's look at a super simple example from a small business. I promise this is where it's all going to click. Okay, so take a look at this. Over on the left, we've listed all the company's assets. We've got their cash, what customers owe them, their tools, and it all adds up to $37,800. Now look over at the right side. You see their liabilities, what they owe, and then you see the owner's equity. And what does that add up to? The exact same amount, $37,800. It's a perfect match. And this is what it's all about. The two sides are in perfect balance. It's not a coincidence, it's not magic. It's because the whole system is designed to make sure that core equation, assets equals liabilities plus equity, is always true. The two sides have to balance. So, okay, we get what a balance sheet is and how it's put together, but so what?
why does this even matter? What can this one little snapshot actually tell us about a business?
Well, it actually gives you three huge insights just at a glance. First, it tells you the company's net worth. What is this business really worth? Second, you can see its financial structure. Is it loaded up with debt or is it funded by its owners? And third, it gives you a sense of its liquidity. In other words, if a big unexpected bill showed up tomorrow, could the company actually pay it? And this brings us to a really powerful idea that sums it all up perfectly. The balance sheet is the only financial statement that applies to a single point in time. Think about that. Unlike other reports that show you what happened over a whole quarter or a year, the balance sheet is unique. It's that one single frozen moment, that financial photograph.
Which, of course, leaves us with a pretty interesting question, doesn't it? If a balance sheet is just a snapshot in time, what's happening between the snapshots? What's the story that connects one picture to the next? Well, that's a story for another time.